start our next session. I'm happy to introduce Macheras, the Vice President of the Regional Economics Division of the Federal Reserve Bank of Richmond. She oversees a professional staff engaged in research and analysis of regional economic conditions and advises internal bank leadership in this area as well. Prior to working for the Federal Reserve Bank, she was a senior economist for the Virginia Economic Development Partnership, where she managed a research group and analyzed regional economic trends and labor market information. And we appreciate you speaking to us today. We look forward to working with you. Welcome, Anne.
Thank you. It's great to be with you all. I'll try to keep it, keep it lively since we're post-lunch here. And, part of my background is in academics, so I'm not thrown by questions. I don't know, I could certainly take a question or two as we go along, and if we need to come back to it later or privately, we can do that too. So I really welcome the opportunity to be with you all. In doing presentations like this, I feel like I'm getting to be with people who are really on the front lines of the economy, really engaged in what's going on locally, and that's part of what I try to track in my role. So Jim and Betsy, I really have great respect for their knowledge of government finance at the state and local level. I'm more of a little bit more of a bigger picture person. So I'm going to talk about the national economy a little bit. This is just the outline. Talk a little bit about the national economy, just to set the backdrop for what's going on in Virginia, where we differ, and then kind of take a deeper dive into, you'll see some of what Jim showed you in his presentation. I'll be coming back to, looking at it maybe a slightly different way. So some of it will look familiar and is a theme worth repeating. So let's start with the national economy. And our broadest measure, this time of year I get a little anxious for the data because our broadest measure of the economy is real GDP. And now, it seems like, yes, we get GDP figures every month, but oftentimes there are revisions to the last quarter number, right? So now we've had 3 revisions to the third quarter real GDP, and third quarter is as recent as we have. We won't get fourth quarter till the end of the month. So I'm always a little anxious to get that look at the full year, 2016, to see what happened. But here we are with the third quarter data. Not bad. Real GDP in the revisions to real GDP, they've been upwards. So we've now most recently ended at 3.5% growth. And to explain this chart a little bit, so the quarterly bars are the percent change in real GDP at an annual rate, seasonally adjusted. But these little blue bars out here are to represent the central tendency of the projections that the Federal Open Market Committee participants submit 4 times a year, the last time being at their December 14th meeting. Those are the projections. It's called the Summary of Economic Projections, and the 12 bank presidents and the Board of Governors submit these projections on real GDP growth, unemployment, on inflation, and on their path for the federal funds rate target, the rate that affects other short-term interest rates in the economy. So this is the projection. So the point here is that this moderate growth path of around 2%, quarter by quarter you see some gyrations there, but 2% is about what we've been getting over the past few years. And by their projections, 2% is about what we can expect to get. Now, they all bring in their own underlying assumptions to the projections they submit. Some of the presidents might be working in some potential fiscal expansion under the next administration. Some may not. We don't get that kind of detail we don't get a full write-up with these summary of economic projections for each individual. Some private forecasters may be coming in. You may see some forecasts that are a little higher. I just saw one this morning from IHS Market that had 2.3% for 2017, 2.6% I think it was for 2018. They had some assumptions around some expansionary fiscal policy, cutting corporate tax rates, for example. So you may see a variation in the range of estimates. I haven't seen any that say we're going to get 4% growth, though. anytime soon, and Jim and I were talking about how that would solve a lot of our problems, right, if we just had stronger growth overall. But my point is there's still a lot of uncertainty over what the policy will be, what policies may create some expansion or work the other way, and we just don't know what those are quite yet. So, I think in my maybe the unemployment chart, I'll also show you these projections, and I'll show that interest rate projection as well. So that's real GDP. Some of the components, so I'm going to focus on the things where I think we've had some questions and where I see some kind of disconnects between different parts of the economy. So on the business side, we look at business investment in equipment, business investment in structures, and then there's also another broad category of intellectual property. So I wanted to show you equipment here because we've had contraction in the spending that businesses make on equipment. And most recently, it was a 4.5% contraction for the annualized rate for the quarter. And I don't have any really good answers to this. Businesses have not felt as good about their reasons to invest. They maybe have not felt quite as optimistic about the economy as consumers have, and I'm going to come back to that. But so there's still some open question, I would say, among economists as to why business investment has been soft as of late. It could turn around, I should say. Again, with businesses feeling better and a few things turning around, looking a little different to them, I think that could quickly change. And you can see, even from one quarter to the next, we've got a lot of variability in business investment. So businesses react and change their capital spending. So let's see, did I skip? There's structure. Sorry, this was capital spending. I think I clicked once a little too quickly. That was equipment. This is structures. So this is spending on all types of structures, commercial, industrial, hotels, all types. Significantly, it also includes for the energy sector, rigs. So when you hear about the rig count, rigs count as structures in our national income accounting. So there was some hit you could see in 2015 and into 2016 where some of that was attributable to the energy sector reacting to declining oil prices and the oil rig count going down. And the resurgence a little bit here in part is due to that. So the good news is that we had 12% growth in structures in this last quarter. So on the business investment side, those two largely canceled out. One was better than the other, but in terms of their weight in real GDP growth, they largely canceled out. And the other category, intellectual property, which I'm not showing the details, is kind of a smaller category. So on the consumer side, and I want to focus on some of the impact, some of the variables that impact the consumer in terms of their spending. Consumer spending is 70% approximately of real GDP, so it's very important in terms of a driver of the economy, and of course it's just as important in terms of the revenue drivers that we need. So personal consumption expenditures, this is the monthly number. Quarterly, with what went with those real GDP numbers, the quarterly growth was 3% in consumer spending, the consumer spending piece. So that helped bring, that helped support that 3.5% overall number. But here's some monthly data. So this gives us some clue of, are we sustaining a good, healthy level of consumer spending into the fourth quarter? And I would say so far it looks pretty good. We have real personal consumption expenditures growing at 2.8% in November, year over year, and real personal income at 3%. And these are growth rates, so don't take the difference there as suggesting that that's the savings rate. The savings rate, if we looked at it, has actually been rose coming out of the into the recovery and has kind of stayed at somewhat elevated levels. So the fact that we've got this time personal income growth is stronger than personal consumption growth, sometimes it flips, and we've still got a pretty high savings rate. So I think this behavior on the consumer side it reflects some consumer confidence that we're not seeing quite as high on the business side, or at least we haven't through the third quarter. So we'll find out a little bit more when we get the fourth quarter data. So that's personal income and expenditures, and where we see this, this confidence of the consumer playing out is in a number of areas. It supports spending on all kinds of goods and services, and the housing sector is one area on which we focus quite a bit. And this is showing single-family permits and starts nationally. And there are a couple of lines here. One is we've got the 90s average for starts in the light blue, and the 90s average for permits, that dashed line. And I put those there because if I took this chart back further to 2005, 2006, you'd see very elevated levels of permits and starts, and maybe that's not a reasonable benchmark. But going back to a more modest pace of growth in the 90s, maybe that is. So we could reasonably expect to get back to the pace of the 90s perhaps over time. And so far we see that we're still running below that by quite a bit, but that we've had consistent improvement in permits and in housing starts. I say consistent because over this past year, we've seen, so if I were to highlight, you might hear news about declines because we were going through this period where month by month we had some decline. But if you look at the overall trend, the strength of the consumer is really still supporting growth in single-family housing. All the discussions about millennials and what they're going to do aside, because that's always a big question. And so speaking of millennials, they might be more interested in multifamily housing, living in the urban centers and in more of the multifamily construction. And there's a lot more volatility here, as you might imagine, just in the nature of these projects. Again, I show the averages from the 1990s, and we well surpassed those. Recently, it's a little, I don't know what to make of this up and down line in terms of starts. If you pay a little more attention to the permits line, though, I think that what I've heard anecdotally is that in many of our markets that this really frenzied construction in multifamily housing is slowing down, but that there's still a reasonable pace of construction in multifamily. So this data may not quite show that, but if you look at permits, it might show, oh, it's just continuing, and you look at starts and you think, I don't know what's going on there. So that's some of the construction side. And again, consumer spending, consumers feeling good about the economy and spending on houses, being, having overcome some of their debt issues from the financial crisis, which is really well behind us now in some ways, yet in a lot of ways, we're still recovering from it. So I want to talk next about the labor market, because that's where we really see, how is it that consumers are feeling better? How is it that we've got this reasonable pace of spending from consumers? And it's because jobs, really. So job growth has been consistently pretty good. You can see here, each bar is represents one quarter, except for this last, this one here is October and November, getting into the fourth quarter. But you can see quarter by quarter we've sustained a high rate of increase in jobs, most recently adding 178,000 jobs in November. We'll get the December data this Friday, so we'll have a better picture, and that's always closely watched. So this, there are a number of caveats I could give to this growth in employment. It's full-time and part-time. Part-time may be taking up a bigger share. We get a little bit of that information from the household survey. And as we'll talk when we get to the state level, where is the job growth occurring, and are we getting the wage growth overall that we like to see? So there's some good news, bad news there. But before we get to that, another measure of the labor market is the unemployment rate. So these are two different surveys. One is a survey of businesses, and so this employment growth number, I always like to look at the job growth numbers, employment growth out of the business survey, even though the household survey gives us employment numbers, but it's not as big a survey. So generally, economists favor the job growth numbers out of the establishment survey. But the household survey tells us the extent to which people are working or not working. Are they working full-time or part-time, but they would prefer full-time? Are they otherwise underemployed for different reasons, and there are some categories of that. But that's all out of the household survey. So the purest number we get from the household survey is really this one, the unemployment rate. People are simply asked, were you working, were you not working? And it's a simple yes or no. And so the unemployment rate most recently was at 4.6% in November. And again, this is those blue bars are the projections from the Federal Open Market Committee participants, the presidents and the Board of Governors. And what you can see there is that we probably don't have a lot more progress we can make to push that unemployment rate down. And there are a couple of reasons for that. Primarily that we don't have a really growing labor force from which to draw to increase employment. So this might be about as low as we can push the unemployment rate, but 4.6% is really good. So the caveats to this number, I mentioned a couple of them. There are people who are underemployed. So part-time, people who are working part-time but would prefer full-time is elevated relative to where it was pre-recession, but it has come down a lot. So there's an unemployment measure called U6 that includes some of these alternatives. The biggest piece is part-time, prefer full-time. It also includes people who have become discouraged, who just have not actively looked for a job in the past 4 weeks, but would take a job if one came their way. So it includes a couple of things, but the largest piece is that part-time, prefer full-time. So right now that rate is at 9.6%. So, compared to that 4.6%, add 5 percentage points to that. But at the peak, when the official unemployment rate, this one was at 10% in 2010, that U6 number was at 17%. So it has come down significantly, just as the official unemployment rate has come down. So, so those are the caveats and the, yes, but not, maybe not as big as an issue as people think. This next piece of information on the labor market, though, is pretty big. And that's the extent to which people are participating in the labor force. So this shows labor force participation, the share of the working age population who are in the labor force, 16 and above. So it has no cutoff, right? It doesn't say 16 to 64 or 16 to 67, it's 16 and above. And I'm showing it over quite a long time period. So, and that's on purpose. So if we go back here in the 1950s and 60s, it was pretty stable. And then we have the baby boomers, big driver, and we also have more women coming into the labor force. So I'd say, baby boomers, maybe principal driver here. You get into the 70s and the 80s, and that's where the rates of female labor force participation were increasing dramatically. But notice that it kind of leveled off around 2000. So well before this Great Recession hit, we were seeing declines in labor force participation. Demographics, again, driving some of that, right? We have the baby boomers coming in. We have the baby boomers starting to retire. And there's a cyclical component to it as well. So when the labor market is really bad, labor force participation can take a cyclical dive. We had a cyclical dive, you might call this here, a cyclical dive, but then that trend, ongoing trend of declining labor force participation just continued. And when you look, if we had more time, I'd show more, I could do a whole presentation on this, but if you look at by age group, it can be surprising because the younger population, the 16 to 24-year-olds, are not participating in the labor force to the extent that they have in previous years or decades. Some of that is more students are getting college degrees. That is a positive. Some of that is kind of not really easy to explain. So I think that this is an interesting area to keep our focus. And most recently, we had the rate at 62.7%. Again, this is like, now it's been kind of going sideways, but when we started hitting those 62 to 63% numbers, it's like, wow, we haven't been that low in labor force participation since the 70s. So it definitely caught a lot of attention. So I mentioned earlier, employment growth has been strong. Wage growth, not as consistently strong, right? It's been really, even as we had consistent gains in employment, we had pretty much, I think I've got some, pretty much around a 2% increase in average hourly earnings. This is just one measure of wage growth, but it's the one I'm choosing to show you today, because you can see this flat 2%. More recently, we've had some improvement. So it did go up to, I think it was 2.8% or 2.9, and now at 2.5%, but still, generally we've been seeing a little bit of upward pressure on wages, and I think that's a good thing. I mean, we'd like to see it. There's no reason why it couldn't push back closer to 3%. It was, if I took this chart back further, in the mid 2000s, it was 3 and 4%. It was pretty high. So we need wage growth as employment growth is good, but we collect taxes on what people actually make. Question in the back?
Yeah, thanks, Ann. A couple things on when you're looking at hourly earnings. First of all, is there a way to kind of ferret out people who are full-time employed but they're underemployed? In other words, they have a PhD but they're managing a McDonald's or something.
Yeah, there's not really good data at that level.
Okay.
So that's yeah. I mean, we get some. The short answer is no, not really.
Okay. And
So.
then the second part, and then, thank you for the honesty. I have a lot of them. The second part is, now we've got a bunch of states who have a $15 an hour minimum wage. Isn't that going to skew graphs like this and others to paint a very different picture? In other words, historical is maybe out the window now?
Yeah, I don't know if I would say out the window. So, because when we think of the jobs for which that minimum wage is really going to provide a meaningful, is really going to act in the labor market. In terms of our overall job market, it's not, in terms of, I don't think the composition effect is that great. I've seen some estimates where it could add a little bit to this growth rate, but alone it's probably, because there are some countervailing effects too. Some would argue that you might not have as many people employed at that higher rate as you did when the minimum wage was lower. So how that balances out, I think is a question. But yeah, to your point though, this does include those compositional effects in the labor market. This is looking at the average, so it's going to take into account people coming in and out of higher paid jobs, or same job getting paid a higher rate. Okay, so last thing, I would not be a good Federal Reserve economist if I didn't talk about inflation, even though inflation hasn't been really a big issue in this economy. In fact, some would argue that maybe the lack of inflation was a little bit problematic. And if you looked, here when we had the overall consumer price index, get this, really not growing at all. We look at this over a longer term, not just the month-to-month fluctuations. But I'm showing you the consumer price index, year-over-year change, and that blue line is the overall, including all items, and the core strips out food and energy prices, which tend to be very volatile. So the core, you can see the stability in that darker line, and most recently at 2.1%, but even the overall rate climbing back up now at 1.7. Officially, 2% is the goal of the FOMC over the longer term, their target for inflation. So when you're starting to get in that 2% range over the longer term, then that's where they're going to be comfortable.
And a kind of brought this up in my presentation. Can you discuss healthcare inflation and how that fits into here? And then maybe service inflation in general, as a use an example, maybe higher ed tuition.
Yeah.
How does that fit into this inflation?
So I heard you say that. I was like, gosh, I wish I knew more of the detail, the underlying detail of these numbers, and I don't. But all of those, costs of services do come into play here. And if you look at, there's something called, I look at this every once in a while. Clearly, I haven't looked at it lately. But there's a survey of consumer expenditures, and you can see. I think it's informative because it gives like the share of consumer spending in different categories, right? So you could see where healthcare fits in relative to things like. So there are some things we think of as being really big, like our grocery bill and our healthcare, and they are. But in terms of our overall spending, we spend a lot on housing. There are other categories that drive consumer spending, or the inflation rate, maybe more than these other pieces that are increasing at a fast rate. But so I don't have a good. It's something I need to look into more, Jim. But it could just be sort of what the weight they have is maybe not as much as we think when it comes to overall prices, even though they may be important drivers in other ways, in terms of our spending at the state and local level, government spending. So that's where we are with inflation. And then finally, I just wanted to show, I'll end with this well, pretty much end with this. Go through the rest of these national slides pretty quickly. But this is the famous, I say famous, in my world famous, but it's, the dot, people call it the dot plot. So this is the only place where we actually see individual projections. Before I showed you the bar, we see the central tendency, we see the median, but we actually get a report out of each. So each of my president is somewhere in those dots, and you can see. So this is where the federal funds rate target is expected to be at the end of the year. So 2016, they're all right there. Obviously, they raised it, and so they all knew it was right there. It was raised to a range of 0.5 to 0.75. So that's the straight line that you see right there. And then really, I'd say the biggest news, so then we see at the end of 2017, 2018, and beyond, 2019, and then beyond, we see the dispersion in their estimates of where the federal funds rate target will be. And the biggest news, I guess, coming out of this was the number of increases that they expected to see. Of course, this time last year, they expected 4 increases in 2016, and we got 1. So you never know, it's always dependent on the incoming data. But the big news here was that there were 3 rate increases expected in 2017, and that's based on looking where this middle, I'm not doing very well, this middle range is right here, sort of where that group is converging, is right in the range that would take us to 1.25 to 1.5, so that would be 3 quarter-point increases in the federal funds rate target. And that federal funds rate target is important because it pushes other short-term interest rates, and that's what this chart is showing, just the immediate reaction in the 3-month LIBOR and in the primary credit rate. So all of those are sort of working off of this federal funds rate target, has an immediate impact on short-term rates and a very direct impact. Longer-term rates, it's not quite as direct, so that's what I'm showing here. It's just the path of the 10-year Treasury bond rate, corporate AAA and BBB, and the 30-year fixed-rate mortgage, all of which have gone up. And that's gone up partly to reflect that time path of the federal funds rate, but it's also gone up because of a little bit of higher expectations of inflation and at least that's what the commentary is saying, and maybe also reflecting, building in a little bit of fiscal stimulus under the new administration. Again, those are kind of unknowns, but we've had some rise in those longer-term rates. So now enough about the national economy. The time I have left, I want to talk about Virginia's economy. and bring us closer to home. So I'd like to start with the employment growth in the U.S. versus Virginia. And this is showing the data through November. We won't get data for Virginia, for the states, until January, I think January 24th is when we'll get December data. And so it lags, unfortunately lags a few weeks behind the national data. But most recently we had growth of 1% versus 1.6% in the U.S. And I was a little dismayed to see that because I had been telling a story in recent months about, Virginia kind of surpassing and then staying on par with U.S. growth after this period where really sequestration hit us pretty hard. And, it took us even to a little bit of employment contraction year over year. And then we slowly started to pull out of that. And we all know in this room what the budgetary impacts were of that for the state. So I was encouraged, for a while to see those numbers. And now I don't want to read too much out of 1 month because these numbers can be volatile. You can have several thousand job gain in 1 month, revision to it, and several thousand job increase in the next month. So I don't want to overstate it too much. The other thing is that with this data, especially getting to this point in the year, this data gets revised. So we'll get a December number in January, and then in March we will have revisions of all of the 2016 data and back into 2015. So it will be interesting to see what that change might bring us. And again, this is just a 1 month, but I don't want to see that trend continue. Certainly, that would be kind of somewhat frightening. So, compared to other states, where does Virginia stand? And this is a map that actually the BLS puts out every month, and you can see that Virginia, compared to other states, we had growth that was below the national average. So we're in this lighter orange. These darker areas are really dark orange, almost brown areas, Florida, Georgia, South Carolina, and then all up and down the West Coast have the strongest growth in employment year over year. So we weren't in the worst shape. We were, obviously not in the best shape either. If we look around the state at the metro areas, again, this is the snapshot. November, it's sort of like, it's actually like just looking at the end point here of, we've got 1% for Virginia year over year, November 15 to November 16. So how did it look in the different metro areas? And the fastest growing metro areas you can see here was Charlottesville and Winchester. Northern Virginia, I've put in dark blue our big MSAs that are the real drivers of that overall number. So Northern Virginia at 2.2% growth was, we need that to be our driver. It accounts for, at different times I've looked at like over 30%, but maybe 35, 37, depending on when you look at it, percent of our jobs in the state. So it's important. Richmond has fallen behind a little bit, 0.8% growth, where Richmond had been growing, it had been one of these top, the top 2 or 3 for a lot of 2016, and it's slipped a little bit. And then Virginia Beach, also very large and important, really just not doing much, kind of flat in terms of job growth. Looking at that last picture, and actually Virginia Beach, we've been seeing that over the past few months. So, so that's where we are, if you look at the how it looks across the state. So, and I haven't done the math, but when I'm looking at the fastest growing MSAs, the top 2 fastest growing being relatively small, and then 2 of our big MSAs really not contributing maybe the way we've been used to. I haven't done the math, but I think the rural areas were probably on a net loss of jobs over this November to November period. So the unemployment rate in Virginia, we looked at that nationally. In Virginia, we had 4.2% unemployment rate in November. And this uptick here, so this has probably been reading about that maybe the past few months when this release has come out. We've had this uptick in the unemployment rate. And so one thing I'd like to say about that is that sometimes these weird bumps get smoothed away with data revisions. And again, I think just we're sort of reaching how, yes, we were lower, we were closer to 3% before the recession hit. And so, you know, whereas nationally we're already down as low as we were pre-recession, we're not quite there yet in the state, so we could have room for that unemployment rate to go down a little further. Again, you know, some data revisions will probably flatten out that uptick. Labor force participation, which I'm not going to show you for Virginia, is better than the national average. So where I showed you that chart where, yes, it's been declining, but we have a higher rate of labor force participation. That works in our favor overall for the state. So compared to other states in terms of the unemployment rate, Virginia is still in the lower half. And you know, you can see here we're in the middle category, or I'd say below the middle category in terms of these ranges of the unemployment rate. So we're still in the lower half, not as low as some of the states out here in the Midwest, I should say. So that's the unemployment rate. Now I'm going to spend the rest of the time that I think I'm running out of, but spend the rest of the time that we have just talking a little bit about some of the industry. What does it look like by industry in the state, and what does that mean for wage growth? So, oops, I don't want to go away from that. So this is just looking, what's the industry composition using 2015 data? And the largest sectors, and I know you have, I hope you can read this on your chart there in the handout, but the largest sectors to emphasize are professional and business services. So government sector, making up 18.5% of our employment, trade, transportation, and utilities, education and health services, and leisure and hospitality. So those are the largest five. So just kind of keep that in mind when we look at where have we gotten the most growth in employment, where have we gotten, where are the highest wages. So I'm going to go back to this monthly data for a minute, because the wage data I can only get from quarterly data that comes out from the Virginia Employment Commission. This is more timely, so just to get that snapshot, in November when we had 1% growth overall in the state, where was that growth taking place and how did it compare to the U.S. in those industry sectors? So a few things to point out. Here, when the U.S. was growing 1.6%, we were growing 1% overall. Almost every sector, U.S. is the dark blue, Virginia is the lighter blue, almost every sector was growing slower in Virginia than it was in the U.S. So, we had kind of this decline in employment was reflected across multiple sectors. One exception is other services, which is kind of a hodgepodge. And I guess you could say on the positive side that our contraction in natural resources and mining wasn't as bad as it was with the U.S. And importantly, some of our largest sectors, so we talked about professional and business services, education and health services, government, all of them are growing more slowly in Virginia. So now I'm going to change time periods on you. And because I want to look at the wage numbers that go along with these employment growth numbers, I'm taking us back a little bit. So June 2015 to June 2016, which will give us our fiscal 2016 year. So I think that is a good frame of reference. But this also happens to be the most recent data, is June of 2016 from the quarterly census of employment and wages. And here I'm showing the thousands of net jobs added in each of these sectors. So some things to notice. Professional business services right here, 13,400 jobs added. Education and health services, which aren't quite as large in terms of their share of economy, were even larger contributors to that employment growth. Another very large sector, which was here, government sector, contracted, and also trade, transportation, and utilities didn't give us as much job growth as we for for being one of our largest sectors, it didn't contribute a lot to the employment growth. So those are some things to observe, just in terms of the net change in jobs by sector. Yeah.
Can we see that in dollars? So that, in case like I noticed, leisure and hospitality is high, but I don't know if pay was versus so the others are lower, might be high.
So you're giving me the perfect lead into the next few slides.
That's what I'm
Okay, so thanks for setting me up. So in the next slide we see, and Jim showed this as well, he actually had more detail in this slide. But this is showing a little bit of more aggregated sectors, the average weekly wage at the end of that time period, so second quarter of 2016. And so the highest wages on the positive side, right, we got decent growth from professional business services, and they pay a high wage. So $1,515 average weekly wage. But balancing this, other sectors that contributed large numbers in terms of employment change don't have very high wages. So education and health services right here at $892, and leisure and hospitality at just $368 average weekly wage. So, you know, the sectoral contribution in terms of employment growth is really different, you know, from what we see in terms of when we look at the wages they actually pay. And I wish we had a better view in the data, like to know even more about how these workers are, you know, how many of these are part-time versus full-time, and things like that, but we don't. Or even more that there's a lot, I think, that goes beyond the data that we are not capturing potentially. The gig economy, right, the share economy, might be slipping through these statistics to a certain extent. So I think that's something that I can't answer today, but I think that raises an interesting question.
All of these standard combinations, because leisure and hospitality makes sense to me. Education and health services not as much, and I didn't know if it masked each by combining. Is that a natural combination? Education and health services?
Yeah, these are called super sectors, and they are combined together. You can get underlying detail. That might have been in Jim's numbers. They were split out. Yeah.
It looks like 4 miles.
Yeah, he had a little bit more detail. But the last slide I wanted to show related to these were, the second to last slide, is just total wages paid in those sectors. So then we're kind of taking the wage and the employment numbers combined. So what was the growth in the wage bill, if you will, from each of these sectors? And so we see actually professional business services does okay. Education and health services, because we had such a good growth in the employment, gave us a decent contribution. Leisure and hospitality, not so much. And if you go back and look at those numbers, you know, I think the information sector might have had the highest, let's see, I could go back. Yeah, the information sector had the highest average weekly wage, and but, you know, we didn't have much of it. So.
Is that what IT people, is that what?
So a lot of IT people are in professional and business services, computer systems design work. Information is going to capture telecommunications and some of the more like hard copy publications, newspapers and media, that type of media. So the last thing I wanted to show is just I don't have as much of a view into the future as I would like to have. It would make my job a lot easier if I had a perfect view into the future on what's going to happen in the state or what's going to happen by industry. But I thought it might be useful since a lot of our discussion today has been, you know, coming from the governor's budget and some of the forecasts there and estimates now. These kind of underpin those overall employment growth numbers that then, you know, feed into some of the other numbers. So total employment is projected, each bar is a fiscal year, the darkest one is fiscal 16, and then we have, so this is 16, 17, 18 for total employment growth. So I was a little focused on this 1.5% growth in fiscal 17, because that's the next point, you know, will we get there? So I'd like to see that November year over year 1% number. start to inch back up, right? Otherwise, I start to worry a little bit about, are we going to hit that number? Again, you know, data revisions are coming in, so that 1% may not reflect reality as well as, may not reflect reality, period. And there's still some time, obviously, where that November number is months away from June.
Quick question on the government sector. Did the statistics break it down by federal, state, and local?
The statistics, I don't remember if they did. This is all from, I have the source down there, but it's all publicly available. It's all out there on the Secretary of Finance website. I just don't remember if it might have had the government broken down. You know, in terms of this, trying to get everything on one chart, I didn't break it out. I think it was there though. But so some of the sectors to focus on too, professional business services, we've got growth here projected of 3.5%. We're lagging a bit behind that number right now, and then slowing to 2.3%. But these are, you know, this is all worked into the biennial budget numbers, projections. But you know, the slowdown in employment growth that we expect in some of these sectors. So, and I should say, you know, I don't think Virginia would be unique in these industry projections. I think, to a large extent, industry level projections kind of work off what's going on nationally, and I suspect IHS Markit's projections on the national economy the trend would be pretty similar for these sectors.
Do you have any idea why the leisure sector is shows such a precipitous decline from this year to next year to the projected 18? Goes from 4.1 to
Yeah. I really don't. Yeah, it does seem like a pretty big drop. So I don't really know what, I don't think it's broken down into any, you know, level of detail that would help us. Sorry. So the last slide, I just wanted to summarize and then take any questions that we didn't already address. Which is I talked a little bit about the national economy and this kind of a disconnect between how optimistic consumers are feeling versus businesses feeling a little less optimistic, at least through the data that we have at hand so far. Labor market measures, by and large, are pretty strong. You can caveat those in different ways, but the overall picture has been pretty decent, and inflation not really causing any worries, kind of moderating back to the 2% goal. There's some uncertainty about the change of administration, so we don't have our president-elect in place yet. He's still president-elect. We don't have detail on his plans. We don't know what Congress will do or won't do to make things happen. There's a lot of uncertainty. And just by and large, businesses don't like uncertainty. So if I went back, I'm not going to go back there, but you know, if you look at what happened in Virginia, our employment growth started to lag the nation well before those sequestration dollars were being cut. Those federal government contracting dollars, I should say, being cut, because businesses were just like, well, we're not going to, you know, we're holding off now because we don't know, you know, the big federal government contractors were buttoning down the hatches, battening down the hatches. So, you know, businesses don't like uncertainty. On the other hand, you know, fiscal expansion, which seems to be in President-elect Trump's proposals, you know, could have some expansionary effect and increase our overall GDP number, whether it's a few tenths of a point or something more significant. A lot of unknowns there. So Virginia's economy here, we have been growing on par with the U.S. You know, a little bit of a slowdown recently. Don't want to overstate it, but you know, that's something I'll definitely be looking at when those numbers come out. And then finally, just to maybe beat a point to death, but because Jim covered it very well as well, it's just this, what's going on in terms of wage growth, even in our driving sectors like professional business services. You know, demographics are coming into play there too. We've got younger workers coming in, older workers who are paid more retiring. There are a lot of dynamics at play that we don't get good data on. So, you know, it makes our jobs harder in trying to predict what's going to happen. Any final questions? Do you have a question? No. Okay, well, thank you. Are we on time? Close? Good.
Thanks, Ann. There's a lot to think about. Thanks for being here. Our next speaker is going to give us some insight about how we can stimulate our local economies to bring about needed job growth. But first, let's take a short break. Be back here by 2:15.